Imagine the government paying you for once, but there is a catch. You have to lend the money. In today's video we are gonna explain what bonds are, the instrument that finances the world. What is a bond? A bond is basically a loan. When you buy a bond, you are lending money, and in return the borrower promises to give you your money back later and to pay you interest. That's it. A bond is basically a contract where the issuer or borrower promises to the buyer or the lender the money back in the future plus interest. Basically, you can be the bank in this situation. Here is a simple example. Imagine your friend says, "Hey, can I borrow $1,000 for 5 years? I'll pay you $50 every year, and after 5 years I'll give you the 1,000 back." If you say yes, congratulations, you just bought a bond. $1,000 is the money you lent or the face value, $50 is the interest at a 5% interest rate, and 5 years is the maturity, or how long the bond will last. So, who actually issues bonds and why? Mainly governments, big companies, and sometimes cities. Governments use bonds to pay for roads, schools, hospitals, pensions, while companies use bonds to grow, expand, and build stuff that will generate money. Let's repeat, every bond has 3 important things. The face value, this is how much you lend, usually $1,000. The interest or coupon rate, this is what they pay you every year for your money, for example 4 or 5%. And the maturity, this is when you get your money. Bonds are by far the safest investment out there, but not without risk. Some bonds are very safe, like strong governments and stable companies. Some bonds are risky, companies that might fail, and countries with debt problems. The basic rule is the safer the bond, the lower the return, while the riskier the bond, the higher the return. The ultimate risk is that the company may not have the funds to return your money in the future, and that you can actually lose money, your initial face value. But that happens rarely, even more rare with government bonds, but still possible. Let's compare bonds and stocks. With stocks you own a part of a company, they offer higher upside, but they're much riskier. In the other hand, bonds are much safer, you lend money to other, you have stable and predictable income, and they're much safer. That's why most investors don't choose one, they use both. Bonds are also extremely liquid, meaning you can sell them to a third party with one click of a button. In other words, you can convert them to cash instantly. Why bonds matter? Bonds are the backbone of financing, giving the world a way to seek investments even if they don't have the money right now.